All right, so this week, obviously, we had the FOMC meeting. The Fed held rates flat, and they didn't really give too much dovish forward guidance in terms of rates. They amended the QT schedule, but they really didn't guide as to when they themselves are even thinking about doing rate cuts. They did give us some pointers on things like unemployment and inflation, but they didn't really guide us in terms of policy. And I think that we're pretty much in a position now where the market's like relying on the prior Fed dot plot, and it's a matter of how far we're deviating from that point. So like the base case is three cuts. I still think the base case is in fact three cuts at the moment. We'll see at the next Fed meeting when those dot plots get adjusted. But I think the more notable thing that's been going on in markets in general is just the floor at which the market's willing to accept forward policy at. So if we take a look at the 30-day Fed funds futures for December of 2025, and it's not really so much the day that matters, it's more of just length out on the curve. We don't want the next Fed meeting. We want some time in between now and what we're measuring. And if we take a look here, it's pretty simple, right? So the market pretty much bottoms when the forward rates bottom for the end of 2025. Again, it's not it doesn't have to be specific to December, but we're just using December here for show. And the market bounces here when these expectations bottom out. We go up, and then SVB happens in early 2023, and market obviously goes down with it. Rate expectations don't take out those lows. They actually bounce with SVB, and therefore market goes higher. And what you'll notice is somewhere around May of 23, rate expectations for cuts start fading, and they fade pretty consistently. And the market goes up in the process. But then it gets real scared all of a sudden when we start taking out those SVB lows, meaning the market is now becomes more restrictive on a forward basis than where we were going into SVB. You notice the market sells off, the forward rate expectations of cuts
So,
continue
so
to
the
fall.
lower it falls, the higher the rate expectation is for December 2025. That's what this is
Correct.
showing. Okay.
Correct. So as we fall down here, markets pretty much this was markets in turmoil. Everyone's scared, right? And then everyone likes to um, associate this bottom with the QRA. We'll talk about that in a second, but I
Well,
think that's more
why
nonsense.
why is that bearish though? If rate expectations are higher in 2025, doesn't that mean we're not going to be in a recession and the Fed doesn't need to cut because growth is strong?
No, because I think that the idea is that there's a general understanding that the Fed is going to get inflation back to target, and if inflation is not problematic, and the Fed is in a restrictive state, then it shouldn't really make a difference. Like the whole premise here is if the Fed is in fact in a restrictive state and inflation is under control, then if they're still at this rate in 2025, at the end of 2025, then there's obviously more problems with the market. If it may be sticky inflation, whatever it may be, and at that point, then the argument stagflation, right? So I think that's really where the markets get spooked, and especially obviously on a forward. You look forward this far and you find out that rates are this much more, I should say, higher versus where they were expected just a few months ago. I think the market gets spooked also as how is growth going to stay elevated in that period of time, right? Like how does growth continue to chug along if the Fed is in fact this restrictive for this long?
Got
And
it. Yeah.
you'll you'll notice, right? Like the market bottoms pretty much after the Fed fund these forward futures bottom, right? Like they start ticking up, market sells off a little bit, bounces, and when we take out the SVB low here, break it back above it, the market's really like on a tear. And you'll notice the market pretty much goes on a tear all the way up until January. We fall here, market falls, right? Bounces, chops around, market continues higher. But then what you'll notice is we continue this move up, but the velocity slows drastically as these futures again take these cuts off the table. And lo and behold, we get back down to where we were in October. The SVB lows were below that. We've recovered since this last FOMC meeting, but we get below that, and the market sells off initially. I think the market's now wondering, okay, it's got to reprice those forward growth expectations with rates that much higher for that much longer. Is there going to be a stagflationary environment? And I think everyone has been quick to call for stagflation, but inherently we don't have that inflation side of stagflation, nor do we have that negative growth side. And that's why when Powell was asked about it, he said he doesn't see the stag or the flation because inflation is not out of control and growth is still strong. So there's really no stagflation at the moment, but the market's going to think on a forward basis, right? We're not looking at the last ISM numbers, right, to say, oh, we're in stagflation. The market doesn't care about that. The market was thinking about that 3 months ago or 2 months ago, right? The market's looking forward, not at the data that you're seeing today.
Yeah, and
So,
now we're seeing this starting to bounce and kind of get out of that problem area, which is bullish for equities, especially if we can see this continue. But
right.
what really caused that move after FOMC? Because Powell wasn't as dovish as I expected him to be. He did definitely turn down a lot of bearishness from the interviewers, like the questions that people were asking. It seemed like they were trying to catch him into like a hawkish slip, which he didn't fall for. And he was reiterating that inflation is under control. But what really caused this reversal in it now?
I think that it's not so much what Powell said, but these rate expectations, as you can see, even they're not. It's not like they're anchored to the Fed dot plot, and they deviate every now and then. There's an arbitrage to be happening, right, or to be made or traded, right? These trade freely, like they go up, they go down pretty widely. So it's not so much what the Fed even says. Obviously, their dot plots are important in terms of what the market's baseline expectations are, but emotions take control, right? Psychology takes control over what people are looking at and what they're feeling. Like, oh, maybe the Fed won't cut, and then they run the cuts from three expected cuts down to one, right, into the FOMC meeting, and then Powell pretty much comes out and says that they're data dependent. The next move will likely not be a hike. I think the market was deviating from those cuts in anticipation that the Fed may, one, obviously base case, hold higher for longer, and some people were obviously thinking about rate hikes. Now, the market wasn't pricing that in, but I mean, you could just if you listen to the recording of the presser, literally every question the man was being asked was about rate hikes for whatever reason.
Yeah,
He was being
it's ridiculous. We get an inflation print that is just barely over expectations, and all of a sudden people are calling for more hikes. It just
right.
doesn't make sense.
Yeah, I mean, look, the other question that we have to ask is, can growth are we in an overly restrictive state? And we don't really know the answer to that. The market's trying to figure that out right now. I mean, if rate cut expectations came back on the table and they were, at or above where the Fed was expecting, or the market was expecting based on the Fed plots, then maybe the market would feel a little bit easier. But the market's shaking out forward expectations right now, figuring out, look, if rates do stay at this range, this lower box here that I have on my chart here, can the market survive? Once the market figured out that we could pretty much chug along with the rates ping-ponging between the ranges that we saw in 2023, it really didn't matter too much where these rates went. Rate cuts, rate hikes didn't, I mean, a lot of rate cuts, no rate cuts. It didn't make a difference. That was no big deal. And then when we get into the beginning of this year, we see 6 rate cuts. And that was overly dovish, right? And the market was easily able to leg up into that. And then when we saw those 6 rate cuts get priced away, again, this goes back to psychology, right? In a way, the base case is 3. The floor is 3 for the Fed, right? If we're going to get less than 3, I think the market it becomes problematic for the market because now you're pricing in less easing than what even the Fed is considering to do. Now, this is not a one size fits all solution. It's very dynamic, obviously, because we were able to rally a lot higher than rate cut expectations fell drastically going into the end of the year, right into August of 23. and we were at the same level in April of 24, yet S&P was much higher. So it's not so point for point, tick for tack. You kind of have to look at what the forward expectations are, where growth is. Is there a weakening in growth expectations? And there generally is some sort. The market is expecting some sort of growth slowdown. It doesn't mean it's very bad. It just means not 3% quarter over quarter real GDP growth consecutively, right? The market's obviously, we just saw 1.6%, but if we look under the hood, like we did in the last podcast, you'll see that demand and consumption is still strong, so that kind of offsets some of that weird wonky decline in GDP. But as long as that consumption stays strong, I think we're going to be okay in the market. But the market's obviously worried about that part of that, because that's what drives the economy. But
Yeah,
I
I think
think
we're entering into a stage now where growth is what matters. Inflation doesn't matter nearly as much as it used to. And even the Fed knows that. The Fed knows that inflation is coming under control. Powell reiterated it. But growth is the one that's hard to measure. And thankfully, we have our system, which is known for being extremely good at measuring growth expectations that are being priced in by the market. And so far, growth is remaining strong. And I think that'll keep us going, especially if we start seeing these rate cuts come back in once the market kind of digests and realizes that inflation isn't really out of control. I mean, we saw crude oil completely reverse this week. That's a huge sign that inflation. That's basically what the inflationistas were banking on, was crude oil prices. And now that we're seeing that reverse, we're seeing other commodities reverse.
I mean, let's just even talk about inflation swaps, like forward inflation swaps over the next 5 years, right? This bottomed out in going into 2024, and it's been on some sort of uptrend ever since. This uptrend is not over just yet. Obviously, this can still, it looks like it can still go up, right? They're in an uptrend still. No, that's not hard to see. But I do think that you have to take these things with a grain of salt. And now some people will say, oh, this number, the market's never accurate in pricing in inflation. That's not what this number is irrelevant. 2.56, if it says 3.56, 6.5, that does not matter. What matters is the direction of where the market is taking inflation expectations in. And what you need to understand here is the market took them up off the December 2023 lows, but we're still below the 2023 highs. Forget about 2022.
Yeah, I think
We're
this sell-off that we've seen in the past few weeks in equities was driven by inflation fears, fears
I
of
think
an inflation resurgence, and we saw that
well,
CPI
that was clear
miss.
here, right? That was clear here.
Yeah, and now I think we're in a position where the market is digesting it and coming to its senses and realizing that, oh, maybe inflation really isn't an issue anymore, and it's going to come back to growth, and it's going to matter on where growth expectations go from here.
Right. I think for a lot of people that are new to macro, or just stepping foot into this realm in the last couple of years, they were bombarded with inflation drivers from 2022 or mid 2021 to through 2023 or early 2023. So I think that a lot of these people, they unfortunately, they don't understand that it's not always inflation that matters. Growth and inflation are the most important drivers in macro.
Yeah, if you're
But
only looking at inflation, you're only looking at half the equation.
right now, without a doubt, inflation was the main driver the last couple of years. But we've been speaking about inflation not being that much of an issue pretty much all year at this point, and we've made it very clear that inflation is now, the market decided to take it as we might have an inflation problem, and we're slowly reversing it. We'll see. We'll talk a little bit about what could come next year. But the market jumped one way very hawkishly, and now it's kind of stepping back. But in terms of actual inflation expectations structurally, we're up off the lows, but we're really signaling just sticky inflation, not so much accelerating inflation. And I think if this does roll over and we start to see the swaps come down, the problem then the market's going to be worried about is inflation slowing because growth is slowing, or is inflation slowing because the Fed is quite restrictive? And I think that that matter. The thing that defines that move is the speed at which it happens. And I spoke about this on X earlier this week, but there's something miraculous that happens with something like, for example, crude oil, right? If you're watching crude oil, and we'll pull up a chart right here. If you're taking a look at crude oil and you zoom out, you'll notice that the market hates it when crude oil falls very aggressively. Like this move down had its chops and it was slow, right? This type of action, if this type what we saw yesterday continues where crude sells off, obviously it looks like it's already slowed, but any drastic selling pressure in crude is obviously positive for the fight on inflation, but it starts signaling like there's a demand problem, right? So people start getting scared, like, oh, why is oil fall? There's no demand for energy products, and energy is a huge part of pretty much every nation, right? You need energy, you need good energy, you need to scale energy to make good products and to have a quality GDP number, right? So I think that when oil starts falling aggressively, everyone kind of takes a step back and says, whoa, what's going on here?
Is there any way to kind of separate those and see if it is an inflation coming under control, or is it a demand issue? Is there a way to somehow separate those two and isolate what the cause is?
I think it really you have to take a step back and you have to just say, look, growth, oil falling like this is fine. Even 3 days, fine. We don't want to see this continue like in this trend for weeks. We want to see it pretty much drop, see how it drops in October. This was very good for the market, right? From I think it was October, or was it December? We have the chart right here. It was October 27th, right? October 27th, right here. You'll notice that the market's selling off first on this down move in crude. And it's after October 27th when the market bottoms. And it's once crude stabilizes in the market, like this type of drastic down move was not good for markets off the rip. It's when the market understands, like, okay, look, it's more isolated towards cost pressures than it is demand. Now, there's an equilibrium where if you go too far one way, obviously, look at COVID, we went negative because there was literally no demand and there was no inflation. So I think you have to take a step back and we have to look at like this type of price action is conducive for inflation expectations, bringing them down. And it's not so negative for growth if we can continue to see it, fall, balance out, and fall. It's when it drops rapidly, I think we have to be concerned. So there's not much to be concerned here at the moment. If anything, we zoom out a little bit. We're below 2021 highs. We're well below 2023 highs. We're still above 2022 lows, and we're above 2023 lows. So we're range bound, and this is healthy to see. This is like showing you that there's still a floor for demand, right? And there's not enough inflation expectation pressure to really drive the price up on this commodity or on energy itself, which is good for inflation expectations. And I think that, like, for example, if we were to take our 2023 lows, I think the market would get spooked. The market would be like, okay, what's going, right? Like, you have to understand that there's like a push and pull. Again, nothing is one size fits all. It's just range bound energy at this point, I think, is good for the markets. Breaking up higher, not good. Breaking down aggressively, not good either. So settling in here, even if we grind lower, fine. I think even if we go bearish trend, I think we'll be okay. And then I even think, like, if this comes down more, I think you're going to see a pickup in rate cut expectations again. I mean, go back to December of 23. That's when we had 6 cuts. The market was expecting 6 cuts. And go back to December 23. The market was expecting 6 cuts at this point, seven cuts for 2024, right? And we faded that, and now I think if oil comes back into balance, we could even possibly see the market pick back up to 3 rate cuts for the year. And so that's where something like bonds. This was a big. Everyone was shook this week on the QRA, and I think that that's a misstatement. Or I shouldn't want to say misstatement is probably the wrong word, right? I think it's a false ideology to get all wrapped up in QRA. I don't think, I think 2 years ago, 12 months ago, nobody cared about QRA. 2 years ago, I guarantee you most of these macro people on X had no idea what the QRA even stands for. So it's like, it's not so much what the QRA is, it's more of what it does to someone psychologically, right? And goes back to the psychological aspect of the Fed funds futures, and it just happens to be similar in this too, right? So short-term price action is driven by headlines. It's driven by, for example, people afraid that if there's going to be too much issuances on the QRA, or the issuance size was going to be too large in the QRA this Wednesday, people were going to be like, okay, or people are expecting to sell bonds on that and just sell bonds, rates go rip, and equities go down. Right? That's a short-term thing. It's a very poor correlation to QRA and equity prices, right? But people will take what they will and they'll build their thesis around it. And because enough people may believe that, you can drive short-term price action with really non-correlated headlines over the long term, right? And then you take a step back, and growth and inflation will really drive the bigger macro trends. And that's why we want to focus on growth and inflation. So I want to take a step back here and go back to that QRA moment where everyone's like, oh, worried about issuances and whatnot. Long story short, you can simplify it like this in the grand scheme of things. The people that are going to buy bonds, if the QRA was going to scare them or add more supply, I should say, on duration, it's unlikely that the people that were going to buy this duration are going to get pulled from equities. This whole idea that the public sector is going to be forced to acquire the duration, they're not going to have enough money for stocks. People are psychological. Either you're owning stocks or bonds. The QRA is not going to change your 60-40. If you're running a 60-40, the QRA is not like, oh man, time to go 80-20, 80% bonds because the rates are going to flush me out. Like, that's not how this works. Okay, unfortunately. Now there's some funds that are limited or tied up in these types of theses, but that's not where the grand scheme of things lie. You have to take a step back and look at the bigger picture.
So is QRA just complete noise and nobody should pay attention to it?
I think there's so I wrote a post on X about this, and I think that if we take a look at what the main driver of the QRA is the 10 is what people point to as a 10-year term premium, right? Long duration term premiums. They're like, oh, okay, so QRA is gonna come in. QRA is gonna be hotter than expected on duration. It's gonna force up term premium and rates in the process because people are gonna have to be rewarded to hold that longer duration, because there is more risk it's in the liquid part of the curve, more duration, more risk, right? That's pretty much the sum of it in simplified terms. And therefore, term premiums have to go up. And people like to zoom out on term premiums. They like to say, oh, look, like term premiums were at like 2.4%, meaning there was an embedded addition to the bonds that you're holding on long duration of this high of 2.4% for the fact that you have to get compensated for risk you're taking. And what you'll notice here is term premium has pretty much stabilized and been very mean reverting ever since Bernanke put in the 2% inflation target back in 2011. And there's a reason for this, because term premium is an outcome of inflation expectations. If you believe that the bonds you're buying are going to fluctuate greatly in real yields, right? In real terms, because of inflation's on the uncertainty behind inflation, you're going to want a higher term premium, right? You're going to want to be paid more to hold that duration. The reason term premiums are shot the way they are, they go ping-ponging between plus 50 and or plus 1 and minus 1%, is because there is a general understanding that the Fed is able to maintain a 2% long-term inflation target, at least to that ballpark. If that target were to be moved or to be unhinged, then you will see that term premium start accelerating again. But until we see that, I really think we're going to see this huge breakout in term premium that everyone's saying that we're going to see. And I think you really have to just take a look at what's going on in the market as a whole. Is inflation really out of control? No, it's not.
Yeah, and also basing your trades on an outlandish narrative like that, something that's, like the Fed completely changing their 2% target. That's not something you want to be basing a trade on. That the odds of that are
that's a tail event. That's what that is.
That's a tail event, and the odds are almost zero.
Yeah, I mean, could we 5 years from now, could that have changed? Sure, but again,
it's not going to be an overnight thing. The market's going to anticipate something like that happening.
Correct. And I think that when you look at this from the bigger picture, right, or the bird's eye view, you price the market's priced for inflation right now to be higher than target, but not really materially running away from us. And I think that we go back to inflation swaps, the sense of control here is aiding in the containment of inflation of term premiums. And I think if we were to see a detach in those inflation expectations, term premiums are going to accelerate. And then this goes back to like you just said earlier, is the QRA noise? Yes, I believe it is. I believe there's one time you need to be focused on the QRA. There's one specific point in an economy or in a nation that the QRA or the issuance schedule of a government becomes important, and that's when they hit the escape velocity going into hyperinflation, right? Because you want to know what's going on in terms of basically an exorbitant amount of debt being issued that you know will likely get inflated and not paid. And now you're going to say, oh, the United States, we just inflate our debt. Yes, but we don't default on it. I'm talking about straight up defaulting, right? That's when you want to know. Yeah, that's when the issuance schedule becomes important, because at that point you need to focus on QRA, because they're going to issue bonds, and at the same time, the talking heads are going to try and contain the situation on air or on TV, whatever, however they're coming across. They're going to want to say, look, everything's okay, and that's when you want to focus on QRA or that whatever that is for a country, right? That type of announcement. You don't want to focus on that now when it's not the main driver at this point in time. There's enough demand to absorb the difference in what Yellen needs to supply now, what she needs to supply in the future. And then you also have the Fed reducing QT to help to a degree. In some way, it's just a macro talking point, because you can spin a narrative around it and you can sell somebody on something, on whatever it is. For example, don't buy bonds, right? Don't buy bonds because of QRA. No, the reason why you shouldn't buy bonds, it has nothing to do with the QRA. It has nothing to do with the issuances of the United States. Okay, it has to do with the fact of this: the bonds will start paying in appreciation and not just coupons when rate cuts come back on the table, and they come in significantly. Meaning, when the Fed starts cutting interest rates, that's when bonds will start doing well. And slightly before that, they'll front run that to a degree, right?
It's basically when they need to panic cut. That's when the real money's made in bonds, not when they just cut once every meeting or once every second meeting.
Right. I mean, they'll go up, right? But we look at the 6 cuts we saw in December, like up off the load, right? That big seesaw we saw here. Remember this? October to December?
Yep.
Right here? Yeah. Look at bonds. Same type of thing, right? So bonds are obviously pricing in, a higher base rate for the Fed right now. The base rate's the key, because that's where the market thinks rates are today. This has very little to do with the QRA. People will claim it does because they're selling you this idea that an extra 100, 200, 300 billion, 400 billion in duration in the most liquid market in the world is going to break it. It's a mistake, in my opinion. And I think that as time goes on, you'll realize that the QRA holds very little value. Again, we go back to what happened here with rates in 2023. Rate cut expectations accelerated greatly well before the market dipped. And people will say, oh, the QRA in October of 2023 was what drove the market all the way up. Now it's the QRA that's going to drive the market all the way down. I don't think that's a good statement to make. And we'll revisit this. If I'm wrong and maybe the market is down, I know for a fact people are going to point to the QRA and be like, oh, well, this, that, the other, like the TGA is going to be 800 billion. Nonsense. I think that's nonsense. We'll revisit this down the road, but I think that's where we can wrap up the podcast today. If you guys have any questions, you can reach out to us on X at the Market Radar, or go to our website at market-radar.com.